everyone and welcome to the Fintelligent Investor series by Rupal Financial Services. I am CA Pratiksha Pai.
And I am CA Sanket Naik.
This is our 15 into 5 is equal to 75 series, wherein starting from 15th August, we do one episode per series for 5 days, wherein we take 5 topics of basic general interest and talk about 15 basic important points about each of these topics. So 15 into 5 is equal to 75, and this is how we are celebrating the 75th Independence Day.
Please like, share, subscribe.
So Sanket, our Kiara, who is 1.5 years old, we have to start financially planning for her higher education. No, tomorrow if she wants to go to medical field and all that, it includes high fees. So we have to start planning, right?
Yes, definitely we should. And capital markets is actually a very good investment avenue here, but we don't have the time. Neither you nor I will have the time to monitor each and every share and look at how they perform and when to enter, when to exit, how to go about this.
For this, there is a very simple solution that we can start investing in mutual funds, right?
Yes, that's a very good idea. But isn't that for a long-term basis?
Yeah, but Kiara is also just 1.5 year old. It's not like she'll go to medical school tomorrow.
Yes, that's right. So it's a very good idea, and I think mutual funds are a way to go. So, Pratiksha, what is a mutual fund? Can you let us know?
Yes, let me first give an example, and on the basis of that example, I can help you understand what is a mutual fund. So, let's say you are very hungry, okay, and you want to eat a cake. And in a bakery, you see that there is a big cake, okay. Now, two things happen over here. That bakery guy will tell you that you have to take the full cake. Then what you'll do? You don't have the appetite to eat the full cake, and neither you have the money to buy the full cake. So, what will you do? You will take some 10 to 20 friends, let's say 10 friends, okay. You will take 10 friends who also want to eat the cake and who also have limited money just like you. And what you tell them, let's all put money and take the cake. So everyone puts in equal amount of money. It can be unequal also, but let us say for our example, say everyone puts equal amount of money and everyone cuts the cake into 10 pieces and each person gets a cake. So it has become affordable also for you, and you have also just got the piece which is enough for your hunger and your craving. Now in the same example, let me tell you one more thing. If there are 4 friends, okay, one person puts in, and say the value of the cake is 100 rupees, okay, one person puts in 10 rupees, one person puts 20 rupees, one person puts 30 rupees, and one person puts in 40 rupees. So the total is 100. But will the cake be cut into 4 pieces? No. The cake will be cut into 10 pieces. So the person who put in 10 rupees gets 1 slice. The person who put in 20 rupees will get 2 slices. The person who put in 30 rupees will get 3 slices. And the person who put in 40 rupees will get 4 slices. So what is happening here is the cake is getting divided and shared as per how much amount you are putting towards that cake. The same is the fund of mutual fund, okay. So here what happens is, maybe someone who doesn't, as you told, doesn't have time to monitor the share market, or doesn't have the knowledge, or is really scared of that risk of themselves putting in their knowledge and patience and getting into the share market. And also another thing, they may not have sufficient funds. So what these people can do is they can go and invest into mutual funds. So mutual funds is where there are a large number of investors investing with the common investing objective, okay. And these funds, what is the meaning of this fund? Nothing but the experts then take all the money of these investors and they invest them into bonds and securities and shares, and there are different types. There are mixtures also, okay. So the fund is collected from investors and then it is invested, and some expert sitting over there is managing your fund. So even when you are sleeping, you're on a vacation, you can be tension free because someone is managing your money on a day to day basis, on at regular intervals. They are seeing how the fund is performing, and so on. So this is mutual funds in as simple way as possible. I've tried to tell. This is what is mutual funds. So Sanket, when should someone start investing in mutual funds?
See, whenever you start earning money, that would be the right point of time for you to start investing in mutual funds. There is no point in saying I will wait for the markets to go up, go down, or whatever it is. It's impossible for anyone to time the market. So whenever you start earning money, whenever you either join your job or whatever you are doing, as soon as you start earning some money, it's the right time for you to start investing in mutual funds.
Right.
So, Pratiksha, one this general point which everyone will have is that what is the difference between a share and a mutual fund?
Okay, so let me tell like this. Say you have a carrot, a tomato, a potato, and some beans. And let's say you have enough money to buy any one vegetable out of that. Okay, let's say for example you buy the carrot. That means you cannot buy the tomato, potato, and beans. But you can take the carrot and make a good gajar ka halwa. Okay, but say if there is a methodology by which you can purchase 1/4 of the carrot, 1/4 of the potato, 1/4 of the tomato, and 1/4 of the beans, then you can make a nice sambar. So the point is that I'm not telling this is good or that is good, but I'm just telling there's a methodology in which either you can have one full thing or a portion of everything. And this is the difference between shares and mutual funds. Okay, so shares is where, let us say you have say 5,000 rupees. Okay, and you look into the share market and you can buy 2 or 3 shares of 2 or 3 companies in that money. Now what if you want to buy and own shares of say 50 companies? Can you buy it in 5,000? Practically not. But that is where mutual funds come in. You can search for funds which majorly fit your preference. What is a fund? Which is a fund is where it is invested further into many other bonds, securities, and it's like a bouquet. Okay, so what you do in the 5,000 that you have, you purchase some units of that fund. So in that proportion you have got the ownership of those shares. It's not like you have one full share. Also another example over here is nowadays you see this co-ownerships of a building, where one building say 5,000 units, there are 5 owners. The owners don't know which 1,000 unit belongs to them, but the 5 are the co-owners of that space. Whereas there may be another property of 5,000 square feet which exclusively has one owner. Okay, that is the difference between shares and mutual funds. And mutual funds is very helpful, wherein people may not have the knowledge or the money to buy a full share or something. They can just put in the minimum amount in mutual fund and get some units with which they will be invested through the fund into various bonds and securities. So Sanket, we are telling always that you can get in with the minimum amount. So can you just let us know what is the minimum amount to start mutual funds?
Yes, definitely. So what happens is, as a lump sum amount and the initial amount, even 5,000 rupees is quite sufficient. And in case of SIPs, it can start with as low as 1,000 rupees. So it's a very small amount. I think most of us can definitely afford to do this. And also there may be some schemes wherein the amounts may be lower or a bit higher as well. But generally it is in this category, in this range.
So it's really affordable, as you said. As soon as someone starts earning, also they can plan to put in at least 1,000 rupees, no?
Yes, definitely, because it makes a lot of sense, and I think 1,000 rupees is something which most people can definitely afford to invest in. So whenever we hear about mutual funds, we keep hearing this term NAV. So can you let us know what NAV is?
NAV is net asset value. So what does this mean? Let us try to decode this with some day-to-day example. Okay, so let us say 5 friends go to a hotel, okay, to eat pizza, and say the pizza has 8 pieces and it's being sold for 80 rupees. Okay, so 8 slices are there and 5 friends. So the first person eats 1 slice, the second person eats 1 slice, the third person eats 2 slices, the fourth person eats 2 slices, and the fifth person eats 2 slices. Okay. Now, while paying the bill for this pizza, will they directly do 80 divided by 5? If the friends want to divide the bill, they'll not do 80 divided by 5 and each person paying 16 rupees. What will they first do? They'll say there were 8 slices. So let us do 80 divided by 8. That is 10 rupees per slice. Okay. Now, how much ever slices one person has eaten, he has to pay for those many number of slices. So the friends who have eaten one slice will pay 10 rupees. And those who have eaten 2 slices will end up paying 20 rupees. So what is happening over here? The sale price of pizza, okay, that will have the base, the cheese, the sauce and the vegetables and whatnot. So the sale price of this pizza is 80 and each person is only paying for how much he has consumed. Okay, so that 80 divided by 8 slices, that is 10 rupees per slice. That 10 rupees is the net asset value of the pizza. Okay, so how can we put it in mutual fund terms? Net asset value is the market value of the fund divided by the total number of units. Okay, and how much ever units one person has, his value will be that net asset value of that unit into how many ever units he is holding. So how we took the example of a pizza. I think this is now very clear what is a net asset value, right?
Yes, definitely. That's a very good example. I think all of viewers will definitely be able to relate to this.
So Sanket, we were discussing that mutual funds is something for the long term. Okay, so can you tell us what is the benefit of staying invested in the mutual fund for a long term?
Yes, definitely. So what happens is when you are staying invested for a longer run, the power of compounding works. The longer you stay, the more returns you get. So that is one part of it. And also market keeps fluctuating. We always keep hearing that today the market has gone up, tomorrow it has gone down, and so on. So you may be wondering what will happen. I mean, whether my investments will go up or down. But not to worry, from what we can always see in the past, in the long run, the markets have always given a good return. So when you stay invested in the long run, you get this effect, and whatever these ups and downs will get adjusted here and you get a good return. So it is always better to stay there in the long run so that you get the better benefits. So two terms which we keep hearing are investing and saving. So what is the difference between the two, and what should we do?
Well, first of all, the outcomes, I can say, or the objective of investing is different and the objective of saving is different. Okay, so in the olden days when banks had just come into, I mean, banks in the sense the formal way of banking had just started, still there were many people who used to keep their money at their home. People used to have all these safes at home where they used to keep their money, and they used to feel that banks are very risky. But now if you see, people have come out of that and they've started putting their savings into the banks because it is safe and it is also giving them some interest, some returns they are getting. But even today people are very very apprehensive about going into mutual funds or share markets also, for that matter, because people feel that it's a huge risk and they will end up losing their money. But it is not like that. Nowadays even putting in savings is just like keeping in the cupboard at home. People have to upgrade that thought process. So let me tell this with a very small example. If you get some seeds, okay, and if you just keep it in your home, what is happening? You are saving that seed. Okay, this is just like how you are keeping it in your home, in your cupboard. Okay, you're just keeping it. It is there. It may not get lost. It may not get stolen. It is there, but it will just remain a seed. But say if you put it in water and you sprout it, okay, you're getting the sprouts, the nutrient value is more, it is better for your body, and you can eat a nice sprout salad and it will be softer, better to eat also. This is like your savings. Okay, you are putting in a bank or somewhere where you are getting savings, it's like sprouts. But now next step, if you take that sprout and if you plant it, then you will get a plant out of it and you will earn more and more and more seeds in the future. So this is investing. Okay, so the first thing where I told, it was just like keeping your money in your cupboard inside your house, just keeping the seeds. Sprouting it was a next step. wherein you are saving it somewhere, it is equivalent to your bank savings or somewhere where you are getting a good benefit. But how to go beyond that, that is investing. Okay, so planting those sprouts and getting plants, that is the next step. So I feel that, major of Indian households are now pretty comfortable with keeping their amounts in the banks and all. But the perspective should change, it should upgrade. People should know that they can go into investments also, maybe a little higher risk, but looking at the history of mutual funds and share market as a whole, you can see to it that, the money has grown multifold. If you had invested 1000 rupees as an FD 30 years back, vis-a-vis if you had invested 1000 rupees in a share market, in a good share. Okay, so that comparison has to be made, and it is just like having seeds versus sprouts versus planting those sprouts. Okay, make your, instead of keeping your money idle, make it work for you. Okay, if you're just keeping the money at home, it's like you're just keeping it there, nothing will happen to it, it won't grow. If you're keeping it in bank, it will grow a bit, it will give you a return, but that is also not enough. It is just like the money is just not working, it is just giving you some returns for keeping it in the bank. But if you're investing it, it means your money is working for you and it is growing manifold. So that is the difference between investment and saving. I'm not telling one is better than the other. Definitely sprouts has its own value, and planting it and growing plants has its own value. It should be a mixed portfolio, not only savings or only investments. It should depend on how much risk appetite you are bearing, and what is the kind of end objective that you have in your mind for your money. So depending on that, investing as well as saving both should go hand in hand. But that public, the general, I'm not telling public, the general opinion that savings is better, that somewhere should be upgraded, I feel. And I feel, in my opinion, investing is better, because you are making your money work for you. And believe me, this is not like you're investing in a, sometimes we say that we will invest in a relative's business, in a friend's business. There, the probability of failure is also high and all. But when you are putting it in mutual funds or shares, you are actually investing in huge companies where experts are sitting and managing the business. And even in mutual funds, the experts are managing the funds. So it is not, you are just not giving it to some Tom, Dick and Harry. It is being invested into some of the best companies which are giving best profits, or best performances, I should say, and giving a good return. So in today's day and time, definitely investment is better than savings. So, Sanket, can you tell us what are the different types of mutual funds?
Yes, definitely. It depends on what these mutual funds invest in. So some are mutual funds invest in equity. They are equity oriented funds wherein at least 65% or so have to be invested in equity, and they could be more than that as well. Then there are some debt mutual funds where they invest their proceeds majorly in debt securities. This could be various private companies, government bonds, and so on. And there are other mutual funds which are balanced mutual funds which invest both in debt and equity, and so on. So that depending on the type of instruments or type of securities they invest in, there are different types of mutual funds.
So Sanket, here there is something called growth related funds and dividend related funds, right? So what is this?
Yes, what happens is certain mutual funds, they are classified as growth, when what happens is they don't give out any dividend. However, there is a capital appreciation which keeps happening. So your value of funds keep growing. You don't get a payout, but you can always sell a certain number of units if you want some money, or you can just retain them as well. However, there are certain income related mutual funds like which give continuous dividends. So here what happens is, whatever growth happens, they usually give it out in the form of dividend to the investors.
So here in the growth related funds, like whatever is the dividends and all that, that is being reinvested, you're saying?
That is a separate, there is something called a dividend reinvestment model as well. That is a different model. There is a growth model. In growth model, they don't pay out any dividend, just capital appreciation keeps happening, and you can always choose to sell a small number of units as well.
So in that growth fund, what you're saying is a person will get capital appreciation, and if they want the money, they have to sell some units and get out that money.
Yes, that's
Whereas in the dividend, they keep getting some payouts, but of course on one side capital appreciation will happen, but not as much as growth funds maybe.
Yes, because there what happens is they tend to pay out most of the amounts as dividends, so there will be very negligible or a small amount of growth there.
Okay. So now we saw what are the various types of mutual funds and what is a growth related fund, dividend fund, and there is something dividend reinvestments also. So can you tell what is the ideal mutual fund for anyone? Like if I want to invest, what is the ideal type of fund that I have to invest in? And can I, once if I choose a mutual fund, can I invest only in one mutual fund or can I invest in more than one types of mutual funds?
Yes, that's a very good question, and I think people should really look into this topic. So, what happens is depends on your goal at the end of the day. Why do you want to invest? So, someone with a long term goal can ideally go for an equity oriented mutual funds, because in equity funds, usually there is a higher growth which keeps happening. For someone with a smaller time period or one with a very short time period, there is also something called liquid fund, wherein you can just get a very small growth on the money rather than just keeping the money idle. You will get some return similar to interest, maybe a bit more than that. So that is one more option. Or there are debt funds where you get a return which is a bit more than FDs, but it will not be as high growth as equities. So depending on your goals, you should decide which fund you want to invest in. And beyond the point, if your goal is very close, you can always exit an equity mutual fund and go for a debt or a liquid mutual fund. These things are some things which you should decide based on your goals. And coming to your other query, wherein you mentioned that can I invest only in one? No, you can invest in any types of mutual funds. It is all dependent on your goals. You can invest simultaneously in equity as well as debt as well as liquid. So there is no such restriction. You can invest in any type of mutual fund. So when it comes to mutual funds, we keep hearing the term SIP, or sometimes people call it SIP, and sometimes there is something called lump sum. So what are these terms? Pratiksha, can you explain?
Yes, we keep hearing the terms lump sum and SIP. Okay, so just as the words denote, first of all, SIP means SIP, systematic investment plan. Okay, so and as it is saying, it is systematic, which means every monthly or something. There are various intervals, but the normal and of course the practical way is monthly, and many people do this monthly investment into mutual funds. Okay, so the lump sum is where you put a lump sum, a huge amount at once into a fund. Okay, so here let me tell with an example that, see, now if there is a glass of tea, for example, I can drink this whole glass at once without stopping. Okay, that is lump sum. Or I can take sip by sip. Okay, it is more comfortable also to me, and some people would be there who may feel it comfortable to drink it all at once. I don't know, but it it depends from person to person. Whatever is comfortable for each. So for me, it is comfortable to take sip by sip. Okay, so it is sip. Okay, so that is what ultimately what is happening. We are consuming the tea. Okay, and but if we are consuming it by via lump sum or sip is a totally different thing, and it depends on what is comfortable. Like for example, let me tell you, someone may have a huge lump sum, okay, which they don't know what to do with it, and they may go and invest it in some fund. They will put in a lump sum, whereas someone else may have just got, say, a promotion or something. He's getting some extra income with which what he has to do, he doesn't know, but he doesn't want to waste it. So what he'll do, that extra money that he has out of his salary monthly, he will invest it SIP as a SIP, that is as a systematic investment plan. So every month he will put a small amount into the fund. So here also, once we say SIP and lump sum, of course the next question will be what is beneficial and all that. So if a person has a lump sum sitting idle, definitely they can put it in some fund and try to get some earning and growth on that money. Okay, but sometimes what is the benefit of SIP is that the mutual fund, when it is equity linked, it rises and falls as per the market volatilities. Okay, and one month if the market is up, maybe your units will cost higher and you will get lesser unit for that same amount, whereas next month if the market is falling, you can get a lot of more units for a lesser price for the same SIP investment amount. Okay, so here what I'm trying to tell is, when it's a lump sum, you are going in all at once, and whatever is the market situation on that day, you are going in at that, you are not making use of the market volatility. Whereas in a SIP, what is happening is you are taking units when the market is up, when the market is down, as a systematic investment plan, month on month, whatever it is, you are just investing, and you are the entire risk at the long term, it is getting adjusted. Okay, so if you ask me, both SIP as well as lump sum is good. Okay, just invest. Okay, because see, everyone will not have a lump sum, but they can definitely do a SIP. Whereas if someone has a lump sum, don't keep it idle somewhere else where there is no growth, rather put it in a fund. Okay, so I think both have its own benefits and disadvantages, but this is what SIP and lump sum means, and I feel that both are good, equally good to be to get invested. Just enter into mutual funds and get invested, and see that money grow. So Sanket, one more thing that we get to hear always is ELSS and the tax implications, or tax benefits related to ELSS. So can you tell us what is ELSS?
Yes, definitely. So ELSS stands for Equity Linked Saving Schemes. So what happens, there are certain types of mutual funds which are designated as equity linked saving scheme. It is not that all the mutual funds or all equity funds will give you a tax deduction. These specific mutual funds termed as ELSS will be entitle you to gain deduction under section 80C. So here what happens is there is a lock-in for up to 3 years from the time when you have invested in it, and once the 3-year period is done, then you are free to redeem the amount.
So how much is the deduction you get under 80C?
So the 80C deduction is 1.5 lakhs, but it could be out of this or it could be out of other items as well. It is for you to decide whether.
So it's overall 1.5 lakhs, not separate 1.5 lakhs for ELSS,
No,
right?
no, it is 1.5 lakhs for everything under section 80C, and this could be one of those items. So now that we have discussed so many points about mutual funds, so one major question could be, what are the benefits of mutual fund?
So here, it is a bag full of benefits, I should say. First of all, the first benefit is that it is a low cost entry. Okay, say if you want to purchase shares of certain big companies, certain shares are like 25,000 rupees a share. Okay, which could be a monthly income for someone. Okay, and whereas in mutual funds, as Sanket mentioned, you can join, you can enroll and get your units at a very very low cost, firstly. And secondly, the fact that the funds are managed by professionals. Okay, because see, even if you can take shares, okay, let's say you can invest 1 lakh every month into shares, but do we have the time, the patience, and the knowledge and enough share market tactics to follow up on these shares? Because everyone would be having certain jobs, and this could be a secondary thing for many people. So does everyone have the time to wait and look at the share market? And nowadays the share market, in a second it can go up and down. So do we have that kind of professionalism in that has to be seen. But in mutual funds, definitely there are professionals who are always looking into this. So you may be on a vacation somewhere, you may be anywhere, but someone somewhere is helping you manage your money. Okay, so firstly, as I said, low cost, and secondly, as I said, professional management. Thirdly, in the amount that you may enter into mutual fund, how many shares can you purchase? Correct. So maybe if you get in at 5,000 a month, so you can't purchase too many shares. Okay, whereas in mutual funds you are purchasing units, and that fund is investing in a lot of shares. It's a mixed bag over there. Maybe there are different sectors, and so many things there. There is some Nifty fund, right, and there's some Sensex fund. We have talked about Nifty and Sensex in our this thing share market video also. So at a single point, you are investing in all of these shares. So the number of shares that you are investing in is more. And why is this beneficial? Say in the fund, one of the shares falls, maybe something else will rise. So there is that adjustment also within the fund. Okay, so that is one of the benefits also for someone who doesn't have a huge risk appetite, right? So for a medium risk appetite, this is better. And while I say this, I should also say that mutual fund is somewhere, I feel, somewhere in middle of FD and share market. Okay, so in share market, it is high risk, okay, but the returns are also very high. Whereas in FD, you are getting a fixed interest. The you will get that interest, that will not go anywhere. The risk is very, very low, okay, but you will get a fixed income, but that is very low, okay. Whereas in share market, the growth is exponential, okay, but mutual fund comes somewhere in between. The risk is mitigated to a large extent, because first of all, the professionals are managing the entire fund, okay, and they will not, of course, invest in a highly volatile share unless you have chosen some fund that is high risk, correct?
Definitely.
So as per your risk appetite, you choose the fund and the professional manages it. So, and as I said again, in a fund there may be various types of shares, which one falls, one rises, so it doesn't really affect the unit per unit value, the NAV, too much, okay. And thirdly, the another benefit of mutual funds is that you invest as per your end objective, okay, whether it is a long term objective, whether it is a short term objective, whether it is a growth objective, whether it is a income payout objective. So depending on this objective, you like, for example, let me tell you, if you have a long term objective, like I told, right, we can plan for Kiara's this education, financially plan for her higher education, so that's a long term plan. And say, for example, we have to put in share market. How can we be 100% sure that whatever shares we put in will definitely rise, correct? So here, but in the fund, I can tell my fund manager that I want to get in long term and I want to get in growth, and then he will tell me what I can go through, and he will tell me the fund. And as I said, a fund will have so many shares, and overall in the long term, even if one or two shares in the fund fail also, but the entire fund as a whole won't fail, okay, because there will be a mix of so many shares. So in the long term, that is really good, okay. And for short term also, if we talk about, if you go into the share market, you have to, if your goal is short term, you will have to invest in a highly volatile stock, okay. And how will you be sure that it will definitely grow in the short term? But in the mutual funds, again, for short term, they may choose volatile. If you want short term high growth kind of a thing, they may choose volatile stocks for you, but at the same time, every share in the fund will not fail. There may be 1 or 2% that will fail, but everything else will perform. So what's happening here is your end objective. As per your end objective, you can definitely plan instead of FD. You can definitely plan via mutual funds, whereas it's bit difficult through share market unless you are an expert who knows A to Z of share markets. But nowadays we see in share markets that, even if one small bit of news comes from some part of the world, it may badly affect some company in the other part of the world, okay. So which we may see as a passing news, but it may affect that company a lot. So that's why I feel that these are the benefits of mutual funds. It is somewhere the balance between FD and share market, wherein FD is least risk, share market is high risk, mutual fund is in middle, and FD is low returns, share market is high returns, but mutual fund is again in the middle, I feel. So Sanket, we are talking about investing in mutual funds, but how do we exit from mutual funds?
Yes, it's a very good question. So, what happens is when a person wants to exit a mutual fund, they have to give a redemption request with the mutual fund where they have invested in. So, based on this redemption request, their amount will be credited to your bank account within a few days. So, what happens is you have to approach the fund house and give a redemption request. Or nowadays, it's also possible to do all these things online as well. You may not even need to visit the branch of the fund house to give a redemption request.
So, but if I want money, but I really don't want to withdraw from mutual fund, because it's performing really well and I know it will grow in future. Then is there some way where I can stay put, I can stay invested in mutual fund, but still use it somehow to get some money?
You want to have the cake and
Eat it as well with the cream and the icing.
So yeah, there are some options. So one of the options is probably you can take a loan against the mutual funds. So a lot of banks and NBFCs, what they do is they give a loan against mutual funds, but they have their own list of mutual funds against which they give. They may not be able to give it against all mutual funds, and also they will have a certain margin which they will apply on this. Could be somewhere around 50% of the fund value, which they will keep as a margin, only the balance will be given as a loan. But this is a very good option because you may want the money only temporarily, but when you exit and again entering back may be very difficult. So rather, taking a loan is also a very good idea.
So if someone wants to buy a home, they want some money for down payment and all, they can take it like this, like they can just mortgage their mutual fund values and get that loan and use it for any personal use.
Again, the word here which is usually used is
Pledge.
So they can do that, and it's a good option. So we'll arrive at our final question. So I want to ask you, so can mutual funds help create wealth?
Definitely. I should tell you that yes, it helps to create wealth, and it also helps to meet all the objectives that we have in our lifetime. Maybe, buying a house, our kids' education, kids' marriage, and a good retirement life. Because I'm not telling this just for the sake of this video, but let me tell you what is wealth at the end of the day. All of us, I mean, nobody's thinking that they have to become billionaires. Of course you have to think in that way, but help to create wealth means, what I am talking about is, it definitely helps you to achieve the certain basic objectives that you have in your life, which your salary may, and salary coupled with loans may definitely help you. But with mutual funds, it is a lot more easier, okay, to buy that dream house, to give your kids good education, and to have a better lifestyle. So, and we never know how the inflation is going to be in the future. I'm not talking future means 1 year or 2 years, say 20 years from now, who knows how it will be. Okay, so if you just see 20 to 30 years before, say in the 90s or in the 2000s, the inflation rate today that we have, the costs that we see today was nowhere near to what it was at that point of time. So at that point of time, if someone has kept an FD, say let's just tell this, if you've kept a 1 crore FD, okay, and getting say 30,000 of interest per month, forget tax and all that TDS, just for calculation sake, let's say it's 30,000 per month. Okay, if that person has told that I'll put 1 crore FD and I have to get that interest every month in my account, so at 30,000 per month in the year say 2000, he could have lived a lavish life. But today also, if he is getting 30,000 a month from that 1 crore FD, it is very difficult. It is very difficult to live that kind of a life today, if you see. Vis-a-vis, if someone had invested 1 crore in a good mutual fund at that point of time, now the fund may have grown 20-30 times, and they may get a great dividend or a capital appreciation, whatever they want. And there is no need to think about pinching corners anywhere. So I feel in that sense, definitely it creates wealth. Because when you see, when you look at how you want to invest in life, as I said, savings is least risk but also low returns, and share market also, it is very high risk. So you don't know what will happen in 20-30 years. A share that is great performing today, maybe it is included in Sensex or Nifty, but you don't know what will be 20-30 years down the line. And nowadays, with the changing dynamics, see, my great grandmother's childhood and my grandmother's childhood may almost have been the same. Okay, similar kind of lifestyle and all. But when it comes to my grandmother's childhood and my mother's childhood, a lot has changed. Certain appliances like grinders, mixers and all have come. And compare my mother's childhood to my childhood, even more appliances have come. Washing machines, televisions, phones. And compare my childhood with my daughter's childhood, there's a dynamic change. It's like we have lived on some other era. Okay, now it's a complete change. The way of living, the houses, the interiors also of the houses, the surroundings in which we live, the kind of mode of travel, everything has changed. So in another 30 years, forget 30 years, they say now 3 years is a different generation. So in another 30 years, we don't know what's going to happen. So better than savings, yes, I should definitely say that it helps to create wealth. But this statement, when I say it helps to create wealth, I'm not saying that you may have a 500 or 1000% growth, though that's not impossible. But I'm not saying that. But I'm saying yes, it will help you be on par with wherever the world is at that point of time, and you can maintain that same kind of living standards and all that. So yes, in that sense, mutual funds definitely helps to create wealth. So we arrive at the end of our 15 into 5 is equal to 75 series, wherein we have taken our 5 topics and we have researched extensively, and we have curated a total of 75 points for you all to watch. If you're watching this video, I should also tell you that there are 4 other videos also in our 15 into 5 is equal to 75 series. I'll be putting it as a separate playlist, of course, so that you can go to the playlist and you can watch all the 5 videos. And I assure you that it is one of the, your knowledge will definitely increase after watching these videos. And we have tried to put in our best brains. We have tried to research to the maximum extent possible, and we have tried to give out the best content so that it helps the viewers. And we have tried to also cover as many possible queries that we found to be very basic and but important. So in that ways, I think it gives out a good knowledge, and I hope you all will watch it.
And if you have any further queries in relation to mutual funds, you can definitely let us know by posting in the comment section. And if you want us to take up any other topics, you can also mention it over here.
Also, if there is any specific topic in which you want a very detailed, in-depth discussion, also you can let us know, and we'll be happy to take it up. Thank you.
Thank you.